Hi, I'm Kyle Rodda and welcome to this week's Investor Spotlight, where we discuss whether US inflation has peaked and how investors may wish to invest in this market if it has. Last week's US CPI data stoked a rally in equity markets as investors positioned for a possible peak in US inflation. But is the excitement premature? If the inflation problem is solved, which areas of the market may outperform? Let's dive into it. First, a look at where we have been. By any metric, inflation in the United States is historically high. When looking at the Consumer Price Index, US inflation hit a 40-year high of 9.14% in June, with the core CPI figure, which strips out volatile items from the data, hitting 6.5% in April. The surge in prices has come from an imbalance of supply and demand. On one hand, the pandemic and the war in Ukraine disrupted global supply. On the other hand, massive fiscal and monetary stimulus fueled very strong demand. This drove too much money to chase too few goods, which has pushed inflation to the levels that we've seen over the past year. Last week's US CPI numbers revealed that headline inflation eased to 8.5% in July, down from 9.1% in June and below the estimate of 8.7%. The core CPI figure held steady at 5.9% and has trended lower since the highs made in April. The data eased fears of runaway inflation in the US and, as you can see from this chart, stoked a fresh rally in US stocks. As we talked about in the past, global investors are rotating into defensive and quality stocks as economic growth slows and financial conditions tighten. When it comes to investing in a slowing inflation environment, however, another kind of stock can also outperform: growth. Growth stocks are companies that are expected to grow their profits at a very high rate and well into the future. While often smaller companies at their early stages of their life cycle, there are growth companies that are more mature and possess the defensive and quality characteristics investors may also desire in this market. Because growth companies are expected to generate profits out into the future, investors value these stocks with a longer duration interest rate. That means as long-term interest rates fall, as inflation eases, the valuations for growth companies become more appealing, resulting in a higher share price. Here we put together a criteria used to screen for these kinds of stocks: market capitalization, cash holdings, 5-year earnings growth, and beta, or the stock's volatility. Here are 4 stocks on the ASX and on Wall Street that may strengthen if inflation has peaked. As you can see, the companies that could outperform in the US are those familiar mega cap tech names. In particular, Microsoft and Google are 2 very large, cash-rich and growing companies with a relatively low beta compared to the rest of the market. When it comes to the ASX, healthcare dominates. While nowhere near as large, CSL and Cochlear offer lower volatility compared to the broader market, offering stronger growth prospects and tending to outperform when long-term interest rates fall. As always, nothing in markets is ever guaranteed. The obvious risk is that inflation has not peaked or is only plateauing, potentially at a permanently high level. If inflation continues to moderate, however, as supply-side pressures ease and tighter global monetary policy moderates demand, growth stocks with quality and defensive characteristics may well outperform.